In the last 3 years, Hammond Power Solutions has been a total return monster. Can they keep pumping out profits like there's no tomorrow? Fasten your seatbelts, folks. This is going to be a good one. Many investors in the last year have become very much aware of Hammond Manufacturing, or HMM.A, as this little stock has been racking up the big returns. In fact, HMM.A is currently, at the time of recording, sitting on a 39.63% total return for 2024. That is not too shabby. However, HMM.A has a bigger brother by the name of Hammond Power Solutions, or HPS.A, and this is a stock that has been tearing up the total returns for the last 3 years. In fact, when we look at their year-to-date total return, it beats HMM.A, and it comes in at 41.91%. In all fairness, HMM.A was beating them most of the year, and only fell into second place with a recent correction. One of the most common questions I get about the Hammond companies is, well, aren't they kind of doing the same thing? Both companies are engaged in manufacturing that is related to electrical components and systems. HMM.A primarily focuses on enclosures, racks, and cabinets, catering to needs for housing and protecting those electrical and electronic equipment. Now, HPS.A, they concentrate more on the transformers and the power quality products, targeting energy management and distribution systems. In other words, when it comes to the big picture, Hammond Manufacturing addresses the need for physical infrastructure to secure and organize electronic and electrical equipment, whereas Hammond Power Solutions focuses on enhancing power efficiency and, of course, distribution. If you think for a moment, this is actually kind of brilliant, as these two companies complement each other, and thus it makes it easier for both companies to serve the same customer base. We will now, of course, shift our focus entirely onto HPS.A. We do not have a recent quarterly report, as their Q4 is going to be released on March 28th. So the data we will be using today is from Q3, but considering the trajectory we have seen in Q4, I do believe that data still holds water pretty well. Join today's conversation. Let me know in the comments if you hold either or both Hammond stocks. Thank you for your participation. If you love this sort of content, be sure to hit that subscribe button for more, and another huge thank you for that click. Before we get into the numbers, there are a few highlights that are rather impressive in their Q3 report. When it comes to sales, their overall sales increased by 20.5% from Q3 just a year ago. This is a great number, but at the same time, I do have to give some credit to the strengthening of the US dollar, which was up 2.7% from the previous year, and that certainly did help. This is another very interesting tidbit. Their Q3 sales in India increased by 36.5%. And this does make sense with India's push to build more infrastructure. Without a doubt, India should be a huge catalyst for sales for years to come. One last point that is bullish, if you ask me, is that their order backlog increased by 11% in Q3. That means there are customers lining up waiting for their services. That's not a bad problem to have. I can totally geek out on Hammond, so we do need to jump into the numbers and see perhaps the numerical anatomy of a profit maker. Of course, as always, if there are numbers involved, we need to call on our calculator captain of number supremacy, Mr. Math. We will, of course, start with the surface data. At the time of recording, their current value came in at $114.95. They've got a market cap of $1.36 billion. Their beta, less volatile than the market, coming in at 0.71. Their earnings per share come in at 5.17. And when we look at that price to earnings ratio, that comes in at 22.20. The average amongst their peers is 55.6. Some of those peers include Severia with a PE ratio of 30, MDA with a PE ratio of 35.7, and of course Hammond Manufacturing with a PE ratio of 6.9. When we look at their price to book ratio, that comes in at 6.30, and the average amongst those exact same peers comes in at 5.7. Here are a couple of healthy statistics for you. Their return on equity, 32.36%. That's nice. That return on assets, that's coming in at 15.14%. That's nice as well. This surface data looks pretty darn good. In fact, I was expecting their PE ratio to be higher with the amount of growth they have had. Okay, let's pull back another layer and dive into their cash. And with those sales being so good, I have some pretty high expectations. They had a revenue of $703.53 million, and their earnings come in at $57.80 million. Those earnings are projected to grow by 13.48% per year. And this is kind of crazy. Last year, those earnings actually grew by 100.6%. Based on that, I'm even thinking that 13.48% may be a little on the conservative side. Their profit margin comes in at 9.2%. They've got a free cash flow of $10.70 million and an operating cash flow of $29.34 million. When we look at their fair value, they have a current value of $114.95. Using a discounted cash flow model, we do get a fair value of $78.19. That is low, and a big reason for that is that this is using Q3 data. It is not taking into account the explosion they experienced in Q4. So it does show them currently as being overvalued by 47%. But you gotta take this one with a grain of salt, as well as their one-year forecast. Their one-year forecast is $89.50, so that says they're gonna drop by 22.1%. Pretty sure that's not gonna happen. I will, of course, be very interested to look at these numbers after we do get those Q4 results, and that Q4 growth is factored into them. Their overall cash situation is okay, and I do really like the growth they have seen in their earnings. Okay, let's jump down another level and take a look at those returns. When it comes to the dividends, they have a smaller dividend. It is a yield of 0.522%. That's a quarterly dividend paid out in the amount of 15 cents per share. Their payout ratio equally as small at 9.67%, but that dividend has been increasing. They do have a 5-year average dividend increase of 10.67%. Let's look at the returns though. On their 3-year, their price rose from $9.67 to $114.95. That is a return of investment of 1,088.73%. Holy banana bread. You can't do better. And their total return after adding in the dividends, that comes in at 1,101.91%. Let's take a look at that 1 year. The price rose from $33.80 to $114.95. So that is a return on investment of 240.09%. Factor in the dividends, we get a total return of 241.72%. And as we mentioned earlier, that year-to-date return on investment, that comes in at 41.91%. They have not yet received any dividends. Those are coming, towards the end of March as well. So we'll get those pretty soon, and that number will go a little bit higher with a total return. Regarding the returns, you don't get much better than this. However, as great as these are, always remember that past performance is not a guarantee of future returns. Okay, let's peel back that last layer and take a gander at their debt situation. They have a total debt of $22.42 million, and their total equity comes in $217.81 million. So that's a nice looking debt to equity ratio of 10.3%. More good news, this debt to equity ratio has decreased from 26.5% just 5 years ago. So they are moving their debt in the right direction. When it comes to cash and cash equivalents, they've got $44.55 million there. Let's look at their short term. Their short term assets come in at $290.11 million. Liabilities come in at $147.58 million. I do like that. Long term, their assets come in at $83.65 million, and their liabilities come in at $8.37 million. I like this even more, and a huge woot, because those short-term assets cover their long-term liabilities. I love that too. Overall, this is a great debt situation, and it does not surprise me, as they do have a good cash situation, and with record sales, that is set. Well, it's set to only continue. It goes without saying that they have enough cash that they could completely pay off their debt if they really wanted to. I think we have enough information. Thank you, Mr. Math. So let's ask that final question. What is my final verdict? I love Hammond, and that does include both companies. I do feel that their demand for their products will stay high, and it may even actually increase. So long term, I am very bullish on this company. For the cautionary investor, sure, you do have to be concerned that the analysts are predicting a lower price. However, once again, as I said before, you have to realize these predictions do not include data from Q4. So on September 30th, the last day of Q3, they were priced at $51.06. So this is a company that has doubled since then, and thus you can see how the math may not be truly reflective of that doubling. After the Q4 report, there will be a new price target, and I have a feeling it is going to be much higher for sure. I believe in this company as being a good total return option for long-term investment. I think even mid-term investors will be happy with the results that they get. For the passive income folks, this is probably going to be a pass, as they don't offer much in the dividend sense. Which is the better of the Hammond stocks? I love them both, but with the massive growth we have already seen in HPS.A, I have to believe the longer-term growth potential will be with HMM.A. Both should do well, but the little Hammond has more room to grow. If you are interested in the Hammond stocks, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on HMM.A. Thank you for watching, and I will see you in the next video.